Hello and welcome to Investors Hangout, your weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. The market was on a free fall on Monday, and there's no denying the fact that there's nervousness among investors. So is this a time to worry or is this a time to strategize? That's exactly what we'll discuss today with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, first up, can you explain what are the main reasons behind the current free fall of the market, and are these temporary or is it something to worry about in the long run?
After the market has fallen sharply in a brief period of time, then the market participants or the brokers or commentators or editors, they are like me, they are able to invent reasons. And the primary reason which has been invented in the context of this big fall is that the Federal Reserve decided not to cut rates. It is very confident about the outlook for the economy, and that also that was one factor. Besides that, the crude oil prices and this and that and the uncertainty in the market are around a new presidency in the US which can have some implication for the domestic market. But my sense is that except for the fact that foreign investors were taking out money from a bunch of stocks, and a good part of the Indian market might not be very cheap. I can't say very expensive, but it may not be very cheap. And that led to this thing, the big decline. But I don't see a very significant, I don't see a significant reason why the Indian market will go into a tailspin. I don't visualize a situation when it is like October 2008, when market falls by 10% and then falls by another 10%. We are not facing any calamity. Things look reasonably, good. Some companies are not so cheap, and many companies have not given any meaningful return. When I look at some of the large companies in the domestic arena, and the kind of companies which have been getting money in the domestic market, they are completely different from the bunch of stocks where foreign investors invest. So that is why the domestic investors' experience of the market fall may be completely different from the one which we see on the broad market. The market fell about 1.25%, or that was also significant. But individual investors might have faced a much severe decline if they hold mutual fund or if they hold their own, own stock portfolio.
Okay, and you mentioned 2008 crisis, and you being a mutual fund historian, can you give us a context of how have markets recovered from previous crashes?
I can actually look back and look at some big drag in the market. What happened after 1992, the Great Indian Scam? That was a complete distortion. There were no FIIs. FIIs were permitted to come to India, and they were beginning to come. And that was the time when most Indian companies were also dying. We saw a drag for 10 years. The market achieved the level of 4,000 in 1992. And to regain that level, it took 10 years. Then we saw the Great Indian, technology boom in 2000, when this new generation of companies, Infosys, Wipro, and Satyam, and all these came into being. They came into being and they started growing so rapidly. And the initial years of Infosys and all these companies, they grew by 30-40%. Money went up by 10x, 5x, 7x. And after that, we saw the decline, because then in the exuberance, the market for these technology companies went up so dramatically that it fell, and then for another 10 years, this bunch of stock, the technology companies never made a comeback on the stock market. Yes. Though they continued growing well in the market. Then came the 2008 crisis. There wasn't a crisis in India, but the crisis in the US was so severe that it had its ripple effect in India. Besides that, before that, India saw its own boom. From 2004 to 2008, we saw the infrastructure boom and a certain kind of companies, and they were able to grow so rapidly. And when that global financial crisis happened, when foreign investors pulled out, and in 2008, the role of foreign investors, the FIIs, was very significant. They were the dominant player in the market. And when they pulled out, it turned out to be a disaster. Market went down from the peak of 20,000 points, close to 20,000 points, or a little above 20,000 points on the Sensex, in January 2008, somewhere around 21st or 22nd January 2008, to a low of 8,500 on the Sensex. less than 50%, and that was a stomach churning fall. The market fell to 8,500 points, which was actually built in about the previous 2-3 years. So market went back by 2-3 years. But the real problem was that most individual investors, they get excited around the peak. And they put most of their money around there. So for them, it was more than 50% decline. And that drag was also 2-3 years. This time round, the market is fairly broad-based. The whole market is expensive, or people are in the multi-cap and the flexi-cap. We have seen that the small cap has made a huge leap in the Indian market. And that is propelled by the domestic investors' participation. Many small cap funds are now 20,000 crore and larger. So that is not small, and people are looking for avenues where they can grow their money. And many of these, I think the biggest problem is that it can take many years. It can be bad, but only if you are a very short-term investor. If you can hang around, it won't be all that bad.
So do you believe that investors should carry on with their SIPs during such volatile times?
Oh, absolutely. If you have been investing when it was expensive, it is more important to be investing maybe a little more when things are cheaper.
Okay. So now, are there any tools or strategies that investors can use to manage such volatile periods and their portfolios effectively during such times?
Little bit. One is that it should be your long-term money. All said and done, if you need the money in 3 weeks' time, you are in trouble. Time should be on your side. Second is diversification. Good times, people try to get narrow. And that is primarily, chasing recent. What has done very well in recent past, people tend to, chase that. That is devastating, because if good part of your money is invested in that would have witnessed a big decline. So time on your side, diversification. Third thing which you should do very actively, and where value research can actually be a little helpful, is you should actively rebalance. If you are a long-term investor, but everybody regrets losing money after you have achieved a certain high. Likewise, if nobody wants to miss out on the market as well. So how do you do that? If you are a long-term investor who still has 10 years to invest, then keep a 75% equity, 25% debt. And look at your dashboard on Portfolio Manager on Value Research. If this 75% has become 85, reduce it.
Okay, and is there anything that investors should avoid in such periods of market correction?
Not sell. Because what happens typically that you have this grand sale going on and everybody goes for that shopping. But when it comes to stock market, when the grand sale begins, everybody runs away. Right. In fact, the sale happens because everybody is wanting to sell. Don't do that. Everybody has understood that SIP is useful, investing for the long run, and everybody has understood the mathematics or the economics or has the risk taking capability, or at least assumed to be. Nobody has the stomach. When you see that big fall in a single day, most people are tempted. I did it 20 years back. I've been preaching all these years, but what happened was, when you see that important money on which a lot of your life situations or goals are dependent, when you see that big fall, it's very unnerving. So have those variables in place which will help you become a long-term investor. And don't log into value research online on the days when the market fall, and that is how most investors do anyway.
Right. Often in your first page columns also you mention, these are the periods when one should stay calm, ignore the noise. It's not so easy to do all of this.
It's not easy.
So how can one stay calm during such periods?
Practice.
Okay. All right. Now moving on to viewers' question. This value research follower, he says that he has 12 years left for his retirement from government pensionable job. Now he has kept lump sum in bank FD, and the monthly interest is invested in flexi cap, small cap, mid cap, momentum mutual fund, total 6 funds, he says. His equity investment is 33% of lump sum in FD. So does he need to increase equity exposure is what he wants to know.
One is that he has got acclimatized himself with, a third of his money is in equity. And he has accumulated it very nicely in an almost risk-free way. And that is the psychology. That is, I don't agree with it, but that's fine. The end result is that you should get used to equity, and you should have a sizable exposure to equity. Now the point is it good enough? No. When you are investing, think of your equity investment should be for the longest period. Your fixed income should be for shorter period because there is no risk of capital. And he has done the opposite. And he has done it successfully in a sense that, it is very important for one to be comfortable with whatever he is doing. He has made a fixed deposit, the interest he is earning, and he is investing that interest income from that fixed deposit, which is taxable, into these 6 equity funds.
Right.
And 6 equity funds of different kind. Now, I have, one small suggestion for him. Because I am a stickler to simple strategies, simple things to be done, and things that can be done in a low maintenance way. And the low maintenance way is, if he buys one multi-cap fund, that is good enough. Or he buys an index fund and one small cap fund, that is also good enough. He buys an index because that will reduce his cost by substantially. Today you have a Nifty fund which is available at 10 basis point. And a normal, any actively managed fund or even on a low cost basis will be about 60 to 75 basis points. So you have a 0.5% advantage all the time. And then in the long run, reducing expense, gaining diversification and investing regularly is the key. And his question is something which I am not the best person to answer, but I would suggest that at this stage, his allocation to equity should be the reverse. 33% of his money is in equity. And 66% is in fixed income. Given that he still has 12 years to go, it should be the other way around. Only when he gets, once you retire, and given that you are conservative and you want to be reassured of your capital, then reduce it to 33%. Right now, I think you should actually, he should take it up to 66%, simplify his portfolio, and on his retirement, target this kind of allocation.
So remember, market corrections are opportunities in disguise, and if you remain patient, stay calm during such phases, you can actually, create wealth for yourself. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.